At some point, you'll have money saved up and you'll think, wow, I should probably invest this somehow, won't you? Taking a quick view of how the markets have responded to the pandemic in the last few months, it's been a roller coaster ride. With high market volatility and an uncertain outlook, most investors found themselves grasping at straws to make the right investment decision. Hey go-getters, welcome to The Early Investors, another profitable episode where you can learn how to become financially free. In today's video, we'll be showing you how to invest in stock marketing. Want to become the next Warren Buffett? Stay with me and find out all the tips and tricks to save your hard-earned simoleons. Before we jump into the video, make sure to subscribe to our channel for more business-related content. First, I know people make an investment in stocks pretty complicated, but we're gonna break things down for you. After this video, you'll know how to actually start investing and how much money you should start with. What are the techniques to find stocks and more? Like all worthwhile skills, learning how to invest in stocks takes some time and effort, but the payoff can be life-changing. Before we get into the real thing, the one thing I want to bring out first is that when you are going to invest, make sure you're making investments based on a logical approach and don't take emotion into account. Some volatility is expected in all investors feeling like they should take swift action. Well, no one wants to miss a golden opportunity or leave themselves needlessly exposed to risk. To start off, let's go with the basics. What is a stock? A stock is a type of investment that signifies an ownership share in a company. We, as investors, buy stocks that we think will go up in value over time. Stock prices fluctuate throughout the day, but investors who own stock hope that the stock will rise in value over time. Not every company or stock does so, however. That's why investors need to expand their money around, buying stock in many various companies rather than just focusing on one. Moving on to the types of investments. There are many strategies like technical analysis, fundamental analysis, passive funds, and behavioral finance. Let's start off with technical analysis. It's the study of chart patterns and statistical figures to understand market trends and pick stocks accordingly. Sounds complicated? Let's go for a simpler explanation. One day, the share price is up, another day it may be down. But over time, if you look at the stock price's progress, you may see trends and patterns emerge. When you learn technical analysis of stocks, you will learn the big role that technical indicators play. But then, not many investors would actually sit in front of a big screen watching a stock's charts all day long as they change. Most people look forward to the long-term investments to learn a company's financial statements, such as the income statement and the balance sheet, to ascertain its growth potential. You could also try to monitor factors outside these financial statements that would increase the company's earnings in the future instead of the day-to-day activities. Now, let's talk about how you can actually buy stocks. Buying stocks isn't as complicated as it seems, but you will need to do some research and learn the lingo before you make your first investment. Here are a few traditional ones that you've probably heard of before: TD Ameritrade, Vanguard, Charles Schwab, Fidelity, and the newer ones like the Robinhood app, which is completely free with no commission fee, M1 Finance, and the list goes on. It actually doesn't really matter which brokerage firm you go with. A lot of them today are pretty similar to each other, but then make sure you do some research beforehand. If you want to figure out what platform's for you, I recommend you Google it. You'll need a brokerage account to buy stocks, which you can set up in about 15 minutes. It may seem pretty confusing at first, but buying stocks is really pretty straightforward. And while you sign up, you could do that for an individual brokerage account, or you'd see tons of other different options like IRA, joint accounts, custodial accounts, which is what you get if you're under 18, and you need the help of your parents, so it's still going to be under their name. Still, your name is also attached to it. Let's talk about passive versus active investing now. Which one's the best option? Whenever there's a discussion about active or passive investing, it can pretty quickly turn into a heated debate because investors and wealth managers tend to strongly favor one strategy over the other. Active investing is what you often see in films and TV shows. It involves an analyst or trader identifying an undervalued stock, purchasing it, and riding it to wealth. It's true, there's a lot of glamour in finding the undervalued needles in a haystack of stocks. But it involves analysis and insight, knowledge of the market, and a lot of work, especially if you're a trader. It requires confidence that whoever is investing in the portfolio will know exactly the right time to buy or sell. Successful active investment management requires being right more often than wrong. In contrast, passive investing is all about the strategy that requires a buy and hold mentality. That means resisting the temptation to react or anticipate the stock market's every next move. This is basically buying a stock and holding it for a couple of years. The goal of this strategy is to basically make more money long term. And to do this, the few factors you need to consider is if you see the company doing well in the next 10 years if you think it's going to grow. For example, let's say you invested $1,000 in Delta. 10 years later, you decide to sell the share. Now, the share is no longer worth $1,000, it's worth $7,000. That is an excellent return. About long-term versus short-term investing, what types of investors should we be in terms of how long we're investing for? The way that most people have succeeded is very much by investing for a long period of time. Long-term investments are those that you know you're likely to keep for a long time, and it allows you to grow your portfolio and meet goals for several years or even decades in the future. On the other hand, short-term investments are those you plan to use to meet financial goals within a shorter time frame. It is always advisable to strike a fine balance between short-term and long-term investments. Moving on to which company you'd actually want to put money into. Thorough research about the company is needed before buying its shares. As stock prices tend to move up and down, careful approach and guidance are needed to hold a stock, when to sell and when to buy. Constant monitoring of the market and the company in particular is needed to make the correct investment decision. You'll actually have a lot of information available to you. One of them is 10K, which is basically an annual report that focuses on the past year, discussing the details in depth. It'll help in future growth and to make a decision of investing wisely. It'll have all the details from the CEO's salary to the company's financial condition, everything. And next is 10Q, which basically talks about what's happened in the last quarter. If you go through this as much as you can, you'll pretty much figure out whether or not you want to invest in it. Whether you're new to the stock market or thinking of going back in, the last thing we're going to go through in this video is why you want to invest in the stock market. If you're someone that wants to build long-term wealth and maybe you don't really have much money, no formula tells you the amount of money you need to venture into the markets. It could just be $10, or it could go very high. Yes. As surprising as it may sound, you can start stock market investing from as low as $10. Therefore, if you feel like you need millions of dollars to start investing, it's time to shed that myth right away. Let's imagine a longer-term example where you're both a good saver and a smart investor. Imagine you invest $10,000 of your savings into the market every year for 30 years. That's $10,000 this year, another $10,000 next year, and so on for 30 years. So in total, you will have invested $300,000 in stocks over 30 years. But guess how much you have in your account at the end of that 30 years? Bottom line, through regular investing, you can turn $10,000 per year into more than $1 million in 30 years. If you didn't know, your hard-earned money is slowly losing its value over time. Terrifying, I know. So if your $10,000 today could buy you an incredible trip around the world in 30 years, when you take it out from under your mattress, it may only be able to buy you 3 nights in a nearby hotel. I mean, yes, it will still be $10,000, but it won't be worth what it was worth when you first earned it. Another one is the dividend. Some companies with the money they make choose to give back some of it to the shareholders rather than reinvest in their own business. Dividend stocks are special because they pay you real hard cash regularly. The stocks will go up in time, which means you might even make some money someday. If stock marketing is something you want to get into, now is probably one of the best times. Even if it requires a lot of work and research, it will be worth it. So investors, the time is up. Thank you for watching the entire video. Oops, did you forget to smash the like button? Don't forget to check out our other videos. So bye-bye until we see each other next time.